Welcome to the deep dive. We've got a really dense stack of material you've handed us. It's covering everything from global finance and AI to geopolitics and hard asset scarcity.
A lot to get through.
A lot. So our mission today is to give you that fast track, to pull out the critical insights on where capital is rotating, and I think more importantly, the physical constraints that are starting to set the terms for everyone. Okay, let's unpack this. The core tension that just, runs through all of this research is this collision.
Right.
It's the high-speed world of digital innovation crashing head-on into the slow, hard reality of physics and, well, borders.
It's the ultimate synthesis, isn't it? The race for infinite digital scale just slamming into the finite nature of the physical world.
Exactly. So we're going to focus on two, I think, monumental themes. First is this structural shift in digital assets toward what the sources are calling tokenized reality.
Meaning assets backed by real-world economic output, verifiable output.
And second, the just unrelenting grip of resource scarcity, how access to energy, water, critical minerals, that's now determining fiscal and geopolitical outcomes.
And this isn't just theory. The sources are really clear on showing exactly where the money is moving to hedge that physical risk.
Absolutely. And that collision, it leads us straight into segment one, tokenized reality and the compute boom. The core thesis that the sources laid out is genuinely surprising.
It really is.
The future isn't about speculative magic internet money. The great irony of the whole crypto movement is that it inadvertently built the perfect plumbing for what the global financial system wanted all along.
On-chain claims on real, tangible things. We call that real-world assets, RWA. And this isn't a funeral for digital finance at all.
No.
It's a capital rotation. It's moving away from purely speculative tokens and directly into productivity. The assets gaining traction are the ones anchored in verifiable cash flows.
You even see this validated in mainstream politics now. I mean, when you see major political figures focusing so heavily on treasury-backed stablecoins,
Right.
they're essentially endorsing the core idea. They want the world holding digitized U.S. government debt on-chain.
But the deeper opportunity, the one the analysis really flags, is beyond just synthetic dollars. It's about building the infrastructure that can digitize hard energy income.
Barrels, molecules, megawatts.
Exactly. Streaming that verified cash flow on-chain. The gravity of the system shifts when global savers start looking past synthetics toward things with real intrinsic cash flow and, geopolitical scarcity.
And there is no better example of this thesis than the case study on CleanSpark, CLSK. The sources describe it as the convergence of three massive structural trades.
You got cheap energy, a hard-cap digital asset like Bitcoin, and the overwhelming, just insatiable demand for compute from AI and HPC.
Most Bitcoin miners, they operate like leveraged speculators.
Totally. They're always waiting for the next halving to save them. CleanSpark, according to this analysis, has built a fundamentally sound industrial machine.
So we're talking 33 data center sites, over a gigawatt of contracted capacity.
And the discipline to accumulate Bitcoin, but like a modernized Franco-Nevada for digital commodities. And crucially, they are profitable today.
Right now.
And they're a top 10 global BTC holder. It's about operational security, cost control, not just leverage.
That distinction is so key. And let's talk valuation, because this is where the sources get pretty provocative.
Okay.
The research estimated a $57 value per share. And listen closely here. That valuation factored in their mining operations, lending income, and the Bitcoin they already own.
So that number was generated before assigning a single dollar of value to the AI or HPC optionality.
Exactly, which raises the question then. If the base business, just running this efficient industrial asset and stacking Bitcoin, already justifies a price well above where it's trading, why is the market ignoring the AI upside?
That's a great question.
The strategic surplus of power they have can be redeployed almost instantly into AI workloads, and those workloads trade at venture capital multiples, not utility multiples.
So the sources conclude that CleanSpark is this unique, levered play on what's going to define scarcity in the 2030s.
Electrons and mathematics.
Simple as that.
So moving from the industrial miners to the tech titans, the analysis defined Google, GOGL, as the key signal for the whole AI trade reset.
Despite all the public hand-wringing about competition, the sources label Google as the only true full-stack AI house.
And what does that mean, full stack?
It means they have it all. The models, their own custom chips, the cloud fabric, the apps, and this is the unique part, a proprietary planetary data reservoir built up over decades. Others build components. Google owns the entire ecosystem.
But the trade isn't only about hypergrowth. The research strongly contrasted that with what they identified as completely mispriced defensive value.
Yeah.
Take Becton Dickinson BDX.
DDX is fascinating. It's basically a near monopoly in the plumbing of global healthcare.
Needles, catheters, IV sets.
Exactly, the essential stuff. But it's been trading at a depressed multiple because of the financial drag from its older diagnostics arm.
And here's the crucial insight that you need to be aware of. BDX is spinning that arm off. They're using a mechanism called a reverse Morris trust.
Which is, for anyone unfamiliar, a very tax-efficient way to separate the slow-growth assets from the core high-margin business.
So what's left, this new BDX, will be a cleaner, higher-growth medtech play, instantly armed with capital for buybacks.
And on a pro forma basis, looking at it after the separation, the sources said it trades at an absurdly low multiple for a company that just sails through economic crises. Classic hidden value unlock.
And you see a similar dislocation overseas with Weibo, the Chinese digital utility.
It's the public square. Culturally indispensable, 600 million monthly active users, operating margins north of 30%.
Yet the market values it like a failing bank.
5.5 times earnings with an 8.3% dividend yield. It's a cash minting machine that the global market has completely orphaned because of geopolitical fears. Just an incredible risk-reward imbalance.
What's fascinating here is the hard pivot in the source material. It's how physical resources now dictate the tempo for, well, everything. High-tech geopolitics.
We have to talk about the energy side of this scarcity equation.
Let's start with an uncomfortable truth that many are still ignoring. The coal paradox.
The asset class that was supposed to be dead.
Completely extinct. And now it's dictating terms for grid stability. The sources documented what they call a genuine energy heresy. U.S. thermal coal demand is running up over 15%.
And why? Because it's still cheaper than natural gas in key markets, and you desperately need those volumes to keep an AI-soaked America switched on. Coal is the fulcrum of grid stability right now.
And that desperate need for physical inputs, it extends deep into strategic minerals. Take tin.
Usually flies under the radar.
Totally. But it's macro critical. They call it the glue of the entire electrified economy. It's essential for solder.
Which connects every circuit board, every chip, every EV component.
And a severe global shortage is emerging. The key factor driving investment here is geopolitical diversification. The U.S. Exim Bank is now actively engaging with miners like First Tin, 1SN.
And they control two of the only scalable OECD-based tin projects left. Taronga in Australia and Tellerhäuser in Germany.
The goal is simple. Secure a stable, democratic supply chain instead of being held hostage by volatile supply from, the Congo, Indonesia, or Myanmar.
That same logic extends to nickel. The research highlighted Power Nickel, PNPN, as a clean, asymmetric bet.
Defense critical, EV critical.
Absolutely. And the company has secured this massive geological structure that looks to be a district-scale system. The source is called the valuation comic compared to the physical resource they've secured.
And we can finalize this scarcity segment by looking at water infrastructure, specifically Cadiz CDZI.
The sources categorize this as late-stage infrastructure that's somehow still mispriced like a speculative penny stock.
Right. At its current market cap, the argument is it's pricing in zero regulatory momentum, zero monetization of its massive storage potential.
And this asset is on the verge of becoming the only new large-scale water supply and storage system in the entire Colorado River Basin, a region facing constant drought.
The valuation dislocation is huge. The research pointed to a net present value of about $1.8 billion against a market cap at the time closer to $400 million.
So the obvious question is, why the discount?
It's California politics. That's the perennial risk. The asset is sound, the need is massive, but the regulatory environment is a hurdle that makes big investors hesitate.
Creating the opportunity for those willing to wait for that political risk to clear.
Here's where it gets really interesting. We now pivot to geopolitical and fiscal friction, and we're going to report impartially on the material's highly skeptical view of ongoing conflicts and fiscal policies.
The source material is very critical of simplified narratives, especially around the conflict in Ukraine. It calls the singular focus on the unprovoked invasion as historically illiterate.
So the sources, they're not justifying anything, but they're forcing us to consider the context of 30 years of NATO expansion, color revolutions, and Western missionary zeal right on Russia's borders.
Exactly. As essential context for understanding the strategic decisions being made today.
But the core conclusion of the analysis is just. It's brutal and pragmatic. The war continues not because one side is strong enough to win,
but because no one is strong enough to dictate terms to the other. And the sources stress the math of attrition. Heroism can't compensate for demographics, shell production, transformers, gas prices.
The analysis suggests the U.S. is suffering from strategic fatigue and has left Europe to bear the price for outsourcing its hard power.
That same critical eye is then applied to climate policy. The sources describe the latest COP30 summit as, and this is a direct quote, the funeral of Western credibility.
Carbon, chaos, and sanctimony.
And it resulted in a word salad of loopholes that let major emitters like China and India basically disregard mandates while securing their own goals.
This connects directly to the difficult fiscal arithmetic we're seeing, especially in the UK. The sources pointed out this massive irony.
Wholesale gas prices are down over 55% since the spike.
Yet consumer energy bills are still rising.
How did that work?
Okay, let's slow this down because the explanation is complex. The culprit, according to the analysis, is the structure of index-linked offshore wind contracts for difference, or CFDs.
Think of a CFD as a guaranteed price contract for renewable producers. So if the agreed price for wind is, say, 150 pounds per megawatt hour, and the wholesale price falls to 75 pounds.
The consumer is legally obligated to pay the difference. That 75 difference is the subsidy.
So the sources provide the specific math. If gas sets the wholesale price at 75 milliwatt, the subsidy needed to hit the wind farm's price might add another 83 ounces. Then you add grid upgrades, another 32 talents.
The result: lower gas prices don't lead to lower bills, they lead to higher subsidy costs. In that scenario, the total consumer cost for wind power jumps to around 190 milliwatt. It's an unsustainable feedback loop baked into the system.
And that difficult math continues with the UK fiscal exodus. The reason rich individuals are planning to leave the UK is simple algebra. It's the new inheritance tax rules.
Exactly. The UK is moving to a new 10-year clock, starting April 2025. If you're a resident for 10 of the last 20 years, your entire global estate gets a 40% tax haircut upon death.
For those with substantial global assets, the calculation is clear. Leaving protects that wealth. It's pure financial risk management, not just a lifestyle choice.
On a more positive note, despite the political noise, the North Sea is presented as an investable opportunity. The new fiscal regime offers crucial clarity.
And in a late-life basin, clarity is arguably worth more than generosity. That new stability means capital expenditure can be unlocked again.
So it's shifting from a struggling growth basin to a reliable yield basin. The analysis pointed out this certainty makes big projects like Jersey Oil and Gas's Buchanan redevelopment instantly bankable. The market can finally trust the rules.
And as a counterpoint to all that chaos, the sources highlighted mispriced, reliable cash flow in companies like Telecom Plus, TEP.
It's a debt-light utility aggregator, trading under 13 times earnings with nearly a 6% dividend yield.
And the sources praised it for just quietly compounding wealth in a market that's starved of reliability. Investors are rewarding businesses that just execute, no drama.
So if we connect this all back to the bigger picture, the entire deep dive, it confirms the central tension for the next decade.
It's the world caught between this accelerating rush for digital profit AI, tokenization, and the immutable laws of physical scarcity.
Whether we're talking about tokenizing real energy streams, the hunt for tin and nickel, or securing water and coal power,
The entire digital dream is utterly dependent on solid physical reality.
the sources conclude with a really powerful synthesis for the 2030s. The only two truly scarce assets that will matter are electrons and mathematics.
It really sums it up.
And that leaves us with our final thought for you, the learner. Given this insatiable push for AI and the absolute dependence on reliable, low-cost physical energy, we ask you this: which constraint will ultimately prove harder to solve globally? The complexity of the math and the AI algorithms themselves, or the political and industrial challenge of reliably securing the electrons needed to run them? Go forth and explore that tension.
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, You are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.